Hello, everyone. Craig here from Wealth Minus Wall Street. Today, we want to talk about 7 financial advisor secrets exposed. And we want you to be aware by not knowing this information, it's most likely costing you 6 or 7 figures of lost retirement savings. We'll share these secrets and give you a pathway to make sure how Wall Street financial advisors stack the game against you to make sure that stops and your best interest is being served. So before we jump in, let me just introduce Wealth Minus Wall Street. My name is Craig Scott. I was a financial advisor for over 20 years, have over 25 years of Wall Street experience. And what I realized was the Wall Street business model was broken. And what I mean by that is it became pretty evident to me that Wall Street and financial advisors put their self-interest ahead of clients' best interest. And I didn't think that was fair. And what happened was with technology and innovation, it was easier than ever for you to prepare and save for retirement in a way that you couldn't do, let's say 10, 15, 20, 30 years ago. So Wealth Minus Wall Street, that's why we built this platform, is we want to share the knowledge and the information from an industry insider doesn't have financial interest in managing your money. And by that, we think we can really even that playing field and put your best interest ahead of Wall Street. And that's really the main key, is provide you the information where you understand how the system works and how to make the system work for you. And that's really the goal here at Wealth Minus Wall Street. So let's jump into these 7 financial advisor secrets. So these are the things that Wall Street financial advisors absolutely do not want you to understand. And we're going to go through each of them today. So the first is we're going to talk about how Wall Street and financial advisors have created a monopoly and why that's not in your best interest. We want to make sure you're aware that investments are just like buying anything else you buy, but Wall Street and financial advisors kind of hide this fact, and we'll show you why they do it because it has a lot to do with how much money they make. The AUM fee, that's probably how 99% of you who are watching this video, you pay what's called an asset under management fee. That's how you are paid, or how you pay financial professionals, and how investments charge. And we're going to show you how that structure is completely out, and really nobody should be paying an AUM fee anymore. Why the focus should be on income and not assets. So what I mean by that is we're all preparing for retirement. That's the reason why most of us save, is to retire on our terms. And there's a reason that Wall Street and financial advisors focus on assets and not income. We're going to share with you why your goals are not aligned with financial advisors. So a lot of times people think that advisors are working for them, which they are. But the reason why you're working with financial advisor and the reason why a financial advisor wants to work with you, they're completely different. We'll explain that to you. We're going to show you that this is really big right now here in this year. You're not diversified. Diversification is a great buzzword by Wall Street financial advisors. It's supposed to reduce risk. This year is another great example why diversification sounds good on paper, but it really doesn't do anything. You could have a really well-diversified portfolio and you could be down 20, 25% this year. We're going to explain and expose that myth. And then this is how we're going to end it with the most encouraging news out there is you control what you pay, right? You have control what you pay. They don't dictate what you pay. Wall Street doesn't dictate what you pay. They dictate it now, but it's because you don't have this information. So what we're trying to do at Wealth Minus Wall Street, again, is give you the knowledge to take back control and say, wait a minute, okay, yeah, you can charge me that because that's what the industry says, but I don't approve of that. We're going to change that fee structure in your best interest. So let's get started with the first one, that Wall Street and financial advisors have created a monopoly. So many of us know that monopolies rarely are good for the consumer, people like us. And most people don't realize there is a monopoly because there's tons and tons of different financial advisory firms out there. There's tons of Wall Street firms out there, right? So in theory, equate that to a monopoly because you see different companies and advisors have their own companies. They work for large companies, right? Here's the secret. Because the fee structure, the way advisors on Wall Street charges fees, is so good for them and so bad for you, they are not going to give you the information that we're going to give you, which is why you shouldn't be paying this type of fee. So I would estimate 99% of advisors charge exactly the same way. Probably about 99% of advisors have the same cookie cutter investment strategies. So whether you realize it or not, the overwhelming majority of every financial advisor you talk to are doing things exactly the same as maybe an advisor you're working with. When you're out there trying to get second opinions or maybe interviewing for another advisor, this is how they stack the game. This is how they stack it, because you're not really getting outside the box thinking. You're not getting a fresh perspective. You're just getting the same tired recommendations and strategies that, again, are good for Wall Street financial professionals and not you. And that's really, at the end of the day, what we're trying to solve for you. Is their advice in your best interest and their self-interest? And as we'll go through this today, it's pretty clear that it's their self-interest is ahead of your best interest. Here's another one that people have some hard time, I think, wrapping their arms around this the first time we explain this to them. But okay, you invest, and most people don't think of investments as a purchase decision. It is. You're buying something. You're buying investments. So buying investments is just like anything else you buy. What do I mean by that when I say buying investments is just buying is like buying everything else you buy? Well, have you ever bought anything that potentially was a little bit expensive without knowing the cost, right? So did you ever buy a house without knowing the cost? Did you ever buy a car without knowing the cost? Did you ever send your kids to college without knowing the cost? The answer is, of course not, right? Society, when you buy anything, there's something called a price tag, right? So we know exactly what something costs. And then what do? We do a cost benefit analysis. We say, okay, it's going to cost me this, but what benefit am I going to get? Is it worth it? And that's pretty much how we come up with most purchase decisions. Well, Wall Street and financial advisors has completely hijacked that, because they do not want you thinking of investments as a purchase decision. Because if you do, the Wall Street financial advisor model will ravel quickly, because it's nearly impossible for them to justify the fees that they charge you if you're thinking rationally about how to evaluate a buying decision, right? So they don't want you to have this information. And it really comes down to, well, why is this? Well, what are they hiding, right? Why do financial advisors and Wall Street make it so difficult to figure out what you pay? Why is it buried on page 16 of the statement? Why, if you're in certain types of investments, it's not even listed? You have to actually go and do your homework to figure out what you're paying. Here's a pretty interesting example. So financial advisors, and I apologize, this might not be great to look at, but you'll get the point. If you sat down with a financial advisor to do a budget for retirement, right, you'll see something like this. And what I just did is I just took a couple sections of these budget templates. And if you go through it, you're going to see something pretty interesting. You see insurance, right? Life, auto, homeowner, rentals, health, dental. You see long-term care. You see professional services fees, elder care, legal and tax, right? There's ways that you can budget this, but did you notice that there's not financial advisor fees, investment fees, right? I mean, to me, this is all you need to know to realize how financial advisors in Wall Street is really scamming you, right? Because they have information on every other expense that you have in retirement, instead of potentially the most expensive cost that you have. Like if your house is paid for, and if you work for a really good company and a bulk of your healthcare is paid for, investments are going to be your biggest expense in retirement, yet there's no mention on them on any of these budget templates. That should make you think. Well, here's why. You don't have to think after this. We're going to explain why it's so bad, because these numbers are staggering. So let's go through that AUM fee, right? That stands for an asset under management fee. Like I said, that's how 99% of financial advisors charge. Almost every investment on the planet charges an AUM. So let's think this through and figure out who this works for and who it doesn't. Well, you pay that fee even when you lose money. So take this year, your account might be down 20, 25%, but you're still paying your advisor their 1% fee. You're still paying the money managers their 1% fee, but you're losing money. So that doesn't make much sense. You pay when you underperform your goals, right? So goals basically means, hey, is your portfolio performing the way it should. So if you're not performing the way you wanted it to, you still pay. You pay more when you add more of your own money, right? So let's say you're contributing a couple $1,000s a month. Well, your fees go up, but that financial professional isn't doing any more work. So that doesn't really make much sense. And then you pay more as your assets increase. So again, let's say it just simple math, you put $100,000 in the account, and let's say in 10 years it doubles, goes to $200,000. Well, it didn't double because of the advisor's expertise. It doubled because the market goes up about 75% of the time. So now in this same example, your fee doubled. Why should your fee double? Just by the market going up, right? This is why advisors in Wall Street does such a good job at hiding these fees. The other thing they use, which is pretty wild, is they use percentages instead of dollar amounts. So you'll say 1%. Well, 1% sounds pretty negligible, right? Who cares about 1%? Well, if you have $500,000, that's $5,000. That's real money. That's $400 a month that you could have for your family, as opposed to paying for a fee that we'll show you later. Really, there's little justification to that fee. So here's how this fee. I'm going to walk you through it. So you have, let's say, your savings, your retirement money, right? You have a big bag of money that you want invested for retirement. You go out and you hire a financial advisor. Well, the financial advisor then goes out and hires the money manager, right? The mutual fund, the ETF. So the financial advisor is really an expensive middleman. They don't manage the money, they just oversee the management. Well, a financial advisor could charge 1 to 1.5% on average. The investments that you're in can be 0.07 if that's a ETF, and then mutual funds can be 1.5% higher. Some variable annuities can cost over 3%. So excuse me, those fees can really add up. But this is a very typical arrangement where you're probably looking around. We always estimate you're paying about 2% in fees if you work with an advisor. Well, remember, 2%, you might be thinking, well, that's not too bad. It's 2%. It's a small number. But let me show you how this number adds up over time. So this hypothetical just says, okay, we have $300,000, let's say an old IRA, and an 8% return. So let's say this person's 50 years old and they say, you know what, I have this chunk of money. I want an advisor to manage it. I don't want to do it on my own. So they go out and they do that. Well, here's the difference in fee structure. So the blue line is just if you went out and again purchased an investment that is guaranteed pretty much to match them. And you said, oh, hey, I don't care. I want low fees and I'm not going to touch it. And then the other one, the middle one, the orange line would be a 1% fee. So that could be a hybrid, maybe hire an advisor for part of your money, or you just hire a couple really good mutual fund managers. And then the last one is 2%. So that would be if you have a financial advisor doing everything for you. And what you should see is how staggering these numbers are, right? That's the beginning. I said 6 or 7 figures of lost savings. Here it is in black and white. So after 30 years of that example, a 2% fee versus just putting all your money in a passive index fund, it's $1.3 million. You didn't have to save a penny more. You didn't have to invest more aggressively. I mean, that's just 1.3 million more dollars for you and your family by just removing an AUM fee where there's no guarantee you're better off. And even if you look at the difference between the 1% and the 2%, it's still $600,000 roughly. You know, so we're talking life-changing money from you and your family. And like I said, the justification for this AUM fee in 2022 is over. There's really no need to be paying this fee anymore because now you have access to the same type of investments that financial advisors do. That wasn't the case 20 years ago, but it is now, right? So removing that AUM fee has never been easier, but it also means you don't have to do it on your own. You don't have to become a money manager. And that's where we come in and we can share with you our financial partners that can help get you where you want to be, but way more cost effective. This is just a quick aside too. This always, I think, should make people pause again with the fee structure. So if we go back to 2000, where we had a pretty bad market, 2000 to 2002, the market was bad. 08, 09, we had a crash. Well, this just assumed that somebody gave an advisor $500,000 and we just matched returns, but we said, let's do the blue line is the S&P index, and then the orange line is the S&P in return, but we'll take 1% out to reflect a financial advisor fee. And here's what's crazy. The FA made $56,000 for 13 years from 2000 to 2012. You made 22,000. And oh, by the way, you were underwater until 2012. So for 11 years, you had lost money. Your financial advisor was making money all day long. Again, I don't know how that makes any sense and is in your best interest. All right, so let's follow this here. So we just explained how much money and how profitable the AUM fee is. So guess what that's going to lead to? Biased recommendations. Okay. So remember we talked about retirement. What is retirement? Retirement is replacing a paycheck, replacing lost income that you're not getting now than when you were working. But here's the thing. Wall Street and financial advisors focus on assets and not income. Well, why is that? Well, because they make way more money off assets instead of income. So what really you have is you basically have an hourglass, right? So you're in retirement and you turn that hourglass over and everything's in assets and it's flowing down to the bottom. And what you're doing is you're stressed day by day, month by month, year by year, saying, oh my gosh, how much have I depleted my assets and how long will it take before that hourglass runs out and I have no assets left, to live off of. So that's what the industry does, is it focuses on assets and not income. We think that's completely backwards and not in your best interest. So let's put that number in perspective. So Morningstar, you've probably heard of, very popular. This tool aggregates risk return profiles for investments. Well, they came out and they said that the new number to withdraw to keep your money available for 20, 30 years in retirement, it used to be 4%. Okay. So just easy math here, $1 million portfolio, you could take out $40,000 a year. And if you did that, your money most likely would last throughout your retirement. Well, with interest rates so low, and how central banks across the globe have manipulated interest rates, Morningstar basically just said 4% doesn't work anymore. It really needs to be 2.8%. So the numbers get even more depressing, right? So now $1 million, you can only generate $28,000 worth of income in order to think that your money will last for a decade. I don't know about you, but that's a pretty depressing number. And the difference between 2.8 and 4 that we talked about, the old 4% rule, is 43% more savings. Right. So we have a retirement income crisis right here, and Wall Street doesn't care. And they're completely focused on assets, again, because that's how they maximize their profitability and not yours. Next thing that Wall Street financial advisors don't want you to know, the investment strategy. Your goals are not aligned. So what you think you're trying to accomplish and what the financial advisor is trying to accomplish, it couldn't be more different. And as you'll notice, the theme is they do this because it maximizes their profits and not yours. So when you're thinking about a financial advisor and having somebody help you manage your money, your goal really should be to be better off financially, right? At the end of the day, that's what you're trying to do. Whether that means, beat the market, or you don't want to lose money, so you want to make sure your money's protected. Whatever your goal is, you should be better off with an advisor. Well, the goal of a financial advisor is to keep you as a client for decades. Their goal is not to meet your goal. It's to keep you as a client for decades, and we'll explain why that's so important. So this is really what we call the smoking gun. So this came from Vanguard. You've all probably heard of Vanguard. And this is actually one of their reports. They actually do train financial advisors. And what they're talking about here is they're basically saying what we just alluded to. The goal for financial advisors is market-like returns. And the reason for that is Wall Street uses herd mentality, right? So market-like returns means, hey, if you're down 25% like you were maybe in 08 or 09, and your friends and family are too, you're like, well, I mean, it's just the market, what else are we going to do? That sounds about right. And that impacts investment decisions. So just to highlight it real quick, the advisor has less to gain from outperformance than lose if the portfolio underperforms instead. Although the advisor might gain slightly more assets from success, he or she might lose some or even all the client assets in the event of failure. The graphical representation shows you that. So at the really top of the bell curve, it's basically saying, if you're hugging the benchmark, you're probably not going to lose the client. Okay. The further away from you go negatively from the benchmark, your risk of losing that client increases. And I didn't put this slide in, but the reason why is advisors could make six figures off of you, depending how much money you have. It could even be more than that. But I mean, we're talking hundreds of thousands of dollars they make. So their main goal is to keep you a client for decades, not to beat the market by 0.5%, 1%. Even though that's what you should want, that's in your best interest. That's not what they're trying to do, right? They're just trying to keep you in line with what the market does. So you don't ask a lot of questions and you keep paying them that hidden fee for decades upon decades upon decades. This is something else that Wall Street won't get out. This just alludes to about that investment strategy. Do you even make money in the market? This came from Dalbar. They're a third-party research firm that analyzes investor performance. And they've been doing this for a long, long time. And the numbers always are quite similar. And what I mean by that is the average investor significantly underperforms the benchmark. Okay. So if you just look at 10, 20 years ending 2021, the average investor in an equity fund made 2.88%. The market was 5.62. I can tell you most retirement plans with that I see, advisors are growing your assets at 7 or 8%. So does that number make a lot of sense? No, it doesn't. But at 2.88%, you could argue that Wall Street is a horrific asset class, right? You might be better off in a lot of different other types of investments. Wall Street never wants you to accurately evaluate this, right? So these numbers never get out. But 2.88%, that's not even keeping pace with inflation. So again, you should be thinking about following that Wall Street status quo, again, whose best interest is it in? And this was interesting. This was a quote from Richard Bernstein, who was a famous strategist at Merrill Lynch, and he had a quote that basically was the secret part out loud. And he said, what's shocking is that simply by investing, most people actually made themselves poorer. They're just shooting themselves in the foot over and over. And I've seen this a lot in my career, and I see it when I meet with new folks. Again, the whole notion of you're better off by investing, it sounds great on paper, but you really need to dig in and do the math, because most people are pretty surprised at the lack of success they have by investing. I always say the only person that's guaranteed to profit in that relationship is the advisor, not you as the investor. And here's just another way of putting this. Most mutual funds, most investments underperform the market. So I know this is tough to see, but this column right here is a 10-year return. And it just shows like multi-cap, 87% of funds underperform. Large cap core down the bottom, 92% of funds underperform. It goes back to, it's really hard to beat the market. So what are you paying that fee for? This is another one that Wall Street doesn't want you getting out. You've heard about diversification, asset allocation. Again, sounds great on paper, but you're not diversified. You're diversified in what financial advisors sell. You're not actually diversified. And again, this is a great example this year. You have your asset allocation fund, your diversification. You might be down 20, 25%. You experienced it in 08, 09. You experienced it in 2000 and 2002. The whole notion of diversification, you could argue, is outdated, but at a minimum, just know that there are ways to actually be diversified outside of Wall Street assets. So here's an example. This came from a report from Willis Towers Watson. And what it shows is allocations to different assets based on institution versus individuals. They're calling alternative exposure. So this would be hedge funds, private equity, real estate, commodities, right? Things that you own, real assets. And what we found is that pensions and endowments have a lot more allocation to these types of investments than individuals. Now, some of you might say, yeah, well, it's because a lot of these big fancy funds, you need a lot of money to get into, and you might need to access them. But the whole notion is you don't need a lot of money to buy alternative assets. They're everywhere. Real estate, golds, investing in a business, right? You name it, buying a franchise. There's tons of things you can do outside of Wall Street control. Most people don't think of this because the people that they hire, who they think are acting in their best interest, aren't bringing these types of investments up, which is why you see the under allocation in alternatives. I know this might be tough to see, but the red and the blue line just means that you increased your return and slightly reduce your risk by incorporating, in this example, 20% of your portfolio in alternatives. Very simple is you can go out and buy a couple multifamily homes or rental income real estate, whatever, even if you want to flip real estate or invest in physical gold or silver, or like I said, invest in businesses and these other types of things. It's never been easier to access these types of investments than it is today. And it just means that you will improve risk adjusted returns by following this type of investment strategy. Wall Street's not going to tell you this because they can't profit out of it. If you move money out of their control, that means they make less money and they don't want that happening. So here's really almost the summary, and the good news is you can control all of the stuff that we talked about. You have complete control, but especially the fees, right? We would argue again that most financial advisors are not worth their fee. We can show you that. But if at the end of the day you say, hey, I get it, but I just want to stick with my advisor, we're not trying to manage your money. So we'll say, sure, you can keep your advisor, but hey, at a minimum, let's renegotiate that fee and make it more aligned with the goals of your family, and not just the financial professional making a fortune for not having to produce and perform. So you can actively renegotiate fees. We can help you do that. We can help you find a new financial advisor if that's what you want, that fits our criteria, meaning who we think charges in a way that gets away from the AUM fee and actually provides value as an advisor, meaning they might manage the money, not just go hire a bunch of mutual funds, because you don't need advisors for that. We can help you find and vet a new advisor if that's what you want. Or there's financial institutions out there that do a great job of managing money without a financial advisor fee. So you still get access to a financial professional. You still get access to all of the same investments that a financial advisor has, but you can cut your fee, your financial advisor fee, by 100%, right? I mean, you completely remove that fee. This is something that obviously financial advisors don't want you knowing. And we think that's very important. Control your fees. It's your money. You worked hard for that money. Stop blindly just giving it away without realizing that there are options for you and you do have a say in what you pay for investments and saving for retirement. So at the end of the day, here's how we can help. So we do what's called a retirement audit. And what we do in that audit is we really cover 4 key factors. We look at your fee structure, we look at your investment strategy, we look at your diversification. Diversification for us means, are you invested simply in Wall Street? And then also, do you have diversification of income, of taxes, right? Most people don't realize if they're just putting the lion's share of their retirement savings into their 401k and rolling it into an IRA, that creates a pretty big tax burden at retirement, right? So that's what we talk about, diversification. And then we also go through and help you understand that your retirement plan that financial advisors say is a plan isn't a plan at all. It's a projection. And that projection is projecting assets because that's where they make the most money, and they're never solving for income. And we think that is clearly not in your best interest, so we help fix that. And then really, here are the results of the retirement audit. Here's typically what we find. Well, we're going to show you how to increase retirement savings simply by reducing fees, right? So you remove unnecessary fees, your money can grow faster and you have more money in savings. We're going to show you how to increase retirement income. As we talked about, that 2.8% number, that's not getting it done. You're failing if that's what you need to withdraw from. So we'll show you how to increase that 2 to 10 times. We have partners that we use, and there's different investment strategies that we can significantly increase retirement income than following the Wall Street status quo. We can show you how to reduce taxes in retirement. As I said, one of the big mistakes most people make is they don't realize that tax deferred does not mean tax free. So they create huge tax bills in retirement. We can show you how to reduce taxes in retirement by improving diversification, by getting out of some of your assets out of Wall Street control. We will actually be able to reduce market risk. So you're not simply tied to what stock and bond prices are doing. And then lastly, we'll show you how to create guarantees in retirement. With bonds failing and inflation surging, there's investments today that look a lot better than maybe they did 5 or 10 years ago. And it's also a way to create guarantees in retirement. So you can either guarantee principal protection, you can guarantee retirement income, you can guarantee that if you have a long-term care event, you have a strategy to pay for that where it doesn't blow up your retirement plan. So these are all the things that by going through the audit, we can help improve your situation in retirement. So I just wanted to thank you for taking a listen. For those of you who stayed, we're offering a free 30-minute call, really to talk about anything. Obviously, we can review what we talked about here, but if you have any questions or concerns about the industry or your personal situation, we'd be happy to go into more detail about how we can help, and we look forward to potentially speaking with you. Thanks again for your time, and have a great day.